The high volatility of cryptocurrencies like Bitcoin provides you with opportunities to make profits from predicting the future prices of these cryptocurrencies. And with a delivery contract, you can grow your cryptocurrency portfolio in multiple folds through these price predictions. So, what is a delivery contract? A delivery contract is a type of crypto futures contract. Crypto futures track the price movements of cryptocurrencies such as Bitcoin, and a crypto futures contract is a legal contract that allows you to buy or sell cryptocurrencies at a future date. Crypto futures contracts allow investors to gain exposure to these cryptocurrencies without having to hold the underlying cryptocurrency.
Crypto futures are tradable on derivative trading platforms like Binance Futures. Binance offers crypto future trading through two flagship products, which are perpetual contracts and delivery contracts.
A delivery contract is also known as quarterly contract and is an agreement to buy or sell an underlying asset at a predetermined price on a specified day and time in the future.
A delivery contract is time sensitive, and during the specified timeline, you can participate in market movements and make a profit by going long or short on a contract. For example, with a crypto futures contract, you can take a long position if you expect the price of Bitcoin to rise. On the other hand, you can take a short position to reduce the impact of losses when the price of Bitcoin falls.
Benefits of delivery contracts. Delivery contracts provide benefits generally associated with crypto futures contracts. For example, delivery contracts offer leverage to traders. Levered trading is the most attractive aspect of futures trading because traders can use leverage to gain significant exposure to an asset like Bitcoin with only a fraction of its total cost.
For example, to buy one Bitcoin on the spot market, you'd need thousands of dollars, depending on the current market prices. But with a futures contract like delivery contract, you can open a Bitcoin's futures position at a fraction of that cost. This is only possible if leverage is used. The more leverage you have, the less money you need to put into a position.
Delivery contracts also allow traders to hedge against unfavorable price change and mitigate the risk of a portfolio, as they provide traders with more options to diversify across trading strategies and generate more profits.
Delivery contracts are also flexible, and they can be collateralized and settled in cryptocurrencies such as Bitcoin, or with stablecoins pegged to the value of the US dollar, such as BUSD or USDT.
What is the difference between a delivery contract and a perpetual contract? A delivery contract differs from a perpetual contract by two main factors. These factors are expiration and funding fees. Expiration. Delivery contracts have a limited lifespan, and they will expire based on their respective calendar cycles. On the other hand, perpetual contracts do not have an expiration date.
Funding fees. Unlike delivery contracts, perpetual contracts carry a funding fee. Funding fees are periodic payments to traders, and they are paid peer-to-peer, which means that Binance takes no fees from the funding rates as they happen directly between traders. And depending on their positions, traders will either pay or receive funding.
However, in the case of delivery contracts, a settlement fee is involved, and it is charged on the expiration date of the delivery contract. The one-time settlement fee in delivery contracts is much lower than the periodic payments associated with perpetual contracts.
How do delivery contracts work? Delivery contracts have an expiration date, and they will expire based on their respective calendar cycle. The calendar cycle for delivery contracts are March, June, September, and December.
Investors should understand what contract codes mean in order to understand the expiration of delivery contracts. Contract codes convey information about a delivery contract's underlying asset, quote asset, and expiration date. Let's use BTC USD quarterly 1231 and BTC USDT quarterly 1231 contracts as examples. The first code labeled BTC, which refers to Bitcoin, is an underlying asset. The following code, labeled USD, refers to the US dollar and is the quote asset. Quarterly, means the contract has a limited lifespan, and 1231 refers to the expiry date, meaning that this contract will expire on the 31st of December. In the case of BTC USDT quarterly 1231 contract, USDT refers to the USDT stablecoin and is the quote asset.
What is a delivery contract's expiration? When a delivery contract expires, a process known as settlement begins. Settlement is a procedure managed by the exchange to close all open positions in an expiring contract. On Binance, all contracts are financially settled. This means there is no exchange of the underlying crypto assets. Once the futures settle, the corresponding settlement profit and loss appears in your wallet balance. On the expiration day, all expired open positions will be settled at a price determined by the exchange. This is known as the settlement price.
How to trade delivery contracts on Binance. Trading delivery contracts on Binance is easier than most beginners might think. All you need is a futures trading account. There are 5 steps involved in trading delivery contracts on Binance. Step 1. Open account. Open a futures trading account on Binance. You need to enable a 2-factor 2FA verification to fund your futures account before you start trading on Binance Futures.
Step 2. Deposit funds. Transfer your assets into your futures wallet. Deposit funds in USDT, BUSD, or cryptocurrencies supported by Binance Futures. Binance Futures support a wide range of crypto assets as collateral.
Step 3. Choose contract. There are 2 types of crypto futures contracts available on Binance. They are USD-Margined futures and coin-margined futures. Select your preferred crypto futures contract. For example, if you want to trade delivery contracts, you can select BTC USDT quarterly 1231 contract from the USD-Margined futures, or select BTC USD quarterly 1231 contract from coin-margined futures.
Step 4. Select leverage. Select the appropriate leverage for your delivery contract.
Step 5. Place order. Place orders according to the various order types available on Binance Futures. For starters, you can select a buy limit or buy market order when purchasing your first delivery contract.
What is the difference between USD-Margined futures and coin-margined futures?
USD-Margined futures are linear futures products that are collateralized and settled in BUSD or USDT, which are stable coins pegged to the value of the US dollar, while coin-margined futures are inverse futures products that are collateralized and settled in cryptocurrency. Instead of using stablecoins as collateral, you can use cryptocurrencies such as Bitcoin, Ethereum, or BNB as margin assets for your futures positions through coin-margined futures.
Benefits of USD-Margined futures. One of the key benefits of USD-Margined futures is that you can easily calculate your returns in fiat. This makes USD-Margined futures more intuitive. For example, when you make 500 USDT in profit, you can easily estimate that the profit is worth approximately $500 since the value of 1 USDT is pegged closely to $1 US.
Benefits of coin-margined futures. Coin-margined futures are best suited to investors that use the hold and earn strategy. If you're a miner or long-term crypto holder, then coin-margined contracts are ideal for you. Since coin-margined contracts are collateralized and settled in cryptocurrency, investors are more likely to hold on to their cryptocurrencies because as prices of cryptocurrencies continue to rise, the value of your collateral will increase correspondingly, and this is a great way to increase your cryptocurrency holdings. Conclusion. Being conversant with the basics of futures exchange helps you win big in this business. Delivery contracts can be very profitable if you have the proper knowledge and risk management techniques to avoid outsized losses. Thus, you should strategize and do due diligence before trading futures and understand both their advantages as well as their risks. Binance allows you to trade delivery contracts conveniently from a single wallet and according to your trading preferences. Start trading crypto futures as delivery contracts on Binance today at www.binance.com/futures. You can also sign up for a Binance account with the link in the video description.
If you enjoyed this video, kindly subscribe to this channel for more videos on cryptocurrencies.